Is venture capital a Ponzi scheme? The first time I read a comment on our channel about this, I just ignored it, but more comments have come up, and now this has actually gotten some media traction. But they're not the same thing, right? Like, let's break it down. Here's how a Ponzi scheme looks like. It's an individual with really good salesmanship, a lot of credibility. They convince someone that they can take their money and multiply it. They actually convince many other people to give them money, and then they invest it when in reality they're just spending it. But the trick is, on paper, those investments are there and they're worth 10 times more. That paper valuation is very fuzzy. You can't really verify it, but as long as you can convince other investors that it's real, it's real. And startups and venture capital are completely different, right? I mean, you do have the guy with the credibility, but that's just a coincidence. You do have the investors. In this case, they're the limited partners in a venture capital fund, and they're the ones who give their money so that the VC fund, the partner, the managers, invested in startups. And then those startup valuations are real. They're not inflated at all, right? Because the valuation of that startup is what other investors agree that it is. Okay, I'm confused now. This is company forensics, the entire venture capital industry. Guys, I never really thought that we would have to write this video on questioning the very thing that we do as startups, but here we are. Some solid arguments, because here's a harsh truth that nobody talks about. Most VC funds lose money. Half of them don't even pay back the investors what they invested. 35% barely pay them back 1x, and it's only a small 15% or so of VC funds that actually make good money. For all the fuzz and the TechCrunch articles and the conferences and the excitement about startups.
What is this?
It's a Juicero.
Typeface AI is raising $100 million.
Don't be slow and boring. Ride boosted.
Most startups fail, and so those investors lose all of their money. These companies that are going belly up are fantastic content for our channel, but the story is often very similar. Some of these companies, they just don't make any sense, and nobody seems to notice until it's too late. They maybe don't care about profits. They don't make money at all. They just work as long as investors keep paying for things. They work as long as investors keep funding them. So what gives? Is it actually a rigged game? Hold that thought. We first need to get on the same page about 3 things that look very similar but are not: Ponzi schemes, pyramid schemes, and startup venture capital. Let's take literally the biggest Ponzi scheme in history. That's Bernie Madoff's investment fund. Madoff used his influence to convince a ton of people to invest in him. The premise was that they were really good at predicting the stock market, so they made investments that paid 10 or 20% per year. That's a return that's not crazy enough for people to raise eyebrows or just call fraud, but exciting enough to get people on board. But what was really happening was that his investments weren't really paying anything. The money that he was collecting from investors was just mostly sitting on a bank account. But if you log into your account, whatever they had, if you log into your account reports, you'd see that your money is making 10 or 20% returns year on year, and that the money that the firm has is growing, but that was all on paper. When people wanted out, when people wanted to cash out, he actually paid them. He just used other investors' money to pay them back along with interest. And that kind of works. For Madoff, it worked for years. Ponzi schemes work as long as not everybody gets the money at the same time. But cue in the 2009 crisis, everything comes crumbling down, everybody wants their money out. That's just a typical Ponzi scheme. Now, pyramid schemes are a bit different. In a pyramid scheme, someone invents a product whose value is fuzzy. Maybe it's a drink that helps you with your wellness, or maybe it's a Forex trading course, or maybe an app that generates no revenue. The point is, the product can be anything.
Calling cards are the wave of the future. These things sell themselves.
How is this not a pyramid scheme?
But the whole point of the scheme is that you enlist people who help resell this product.
The more people that get involved, the more people who are investing, the more money we're all gonna make. It's not a pyramid scheme. It's not even a scheme per se.
And so you pay to become this member. You make a little bit of money reselling this product, but your real deal is enlisting other people to resell as well, because you really make money from their membership fees and the membership fees of other people that they bring in. So if you get in early, you actually stand to make some money from the people you subscribe and the people that they subscribe as resellers. The problem, of course, is that pyramid schemes fall apart very quickly because the product is shit. Nobody really wants to buy that product, and there aren't enough people in the world to sell it to. If you get at the bottom of the pyramid, you're just out of people to target.
I have to go make a call.
Now, this is not to be confused with MLM, that's multi-level marketing, where the product does have some value. Herbalife is probably the classic example of a product or a company that just lives in this very gray area between being a pyramid scheme or being a legal, because MLMs are legal, being a legal multi-level marketing company. But now let's look at startups. Some founders, they get together to build, say, a social media platform. Let's call it Instacam. It makes no revenue, so they depend on their seed round of investors to fund their salaries, their office, their servers, their marketing. The only way this company can survive is if they convince other investors to commit more money, and they often do. The first round of investors gets a percentage of the company in the form of shares. Let's say that it's $1 a share for the first round. But then the next round of investors comes in, and they get in at $4 a share. So that original investment is worth, on paper, 4 times more. And this goes on to Series A and Series B, and you get the idea. The company needs more and more rounds of funding to keep working. And it still makes no money. It still needs the extra funding from investors. And then you have those shares that the founders and the first investors got. They were worth $1 a share, now they're worth $20 a share. Now, if the team refuses to ever monetize this product, then the value of those shares is always a question mark. It's just the value that other investors put on those shares. And maybe that's based on worthless things like users or engagement. And they also depend on some other investor to validate that value per share. This time, maybe it's a company that's acquiring them at this virtual price per share that's not backed by any revenue. If they run out of investors to target, the company will go bust and everybody will lose everything. And of course, investors can't recover any of that money because it was actually spent on salaries and marketing campaigns and office swag and beer at the office. So yes, if you put it like that, a startup in a venture capital is just uncanny. It looks so much like a pyramid or like a Ponzi scheme, but the venture capital structure is even fuzzier.
It really depends on which type of VC that you're speaking to as to whether it resonates or not. We raise a fund together. We invest into great companies. We are patient. We wait for the long-term outcome, which is an IPO or an exit with a handful of these businesses. And then we all make money together. That, I think, is actually what's being sold as what venture capital is. But then there's another side of venture capital that is being played. Me and Kaya, we decide to raise a fund, but we tell a really good story. We raise a lot of money. Let's say that we raise $1 billion, okay? That means we're guaranteed in a traditional fund structure, 2% of that $1 billion over the next 10 years guaranteed. That's $20 million. Now, the way that we can continue to raise more capital is by generally showing that there is progression in the portfolio in the form of paper markups. If we invest in a founder, let's say at $1 million valuation to keep the math simple, and then that founder then goes on to raise subsequent funding at a $10 million valuation. And it doesn't even matter whether the investments turn out to be great or not. The GPs, the general partners, the people that started the fund will end up being rich no matter what, because they had this work and start to feel Ponzi-like, because you're promising these paper markups that are growing and growing and growing, they may never realize.
Remember, a VC firm raises money from limited partners, and they invest from that pool of money that they raised. And they make money, the firm makes money in 2 ways. First, by collecting a 2% fee of everything that they raise, and second, by collecting a 20% take of the earnings of the companies they invested in if they get sold or if they go public. So say a VC fund raises, say, $10 million to invest in companies. They will take $200,000 as a management fee, and then they will use the rest to invest in startups. A couple of years later, they've invested all that money. The money is still in those startups. It's in their best interest for the value of those companies to be high, meaning to bring other investors to those companies who help increase that value. Now, 2 years is too early to know if these companies are gonna make it. But with the proof, the validation from other investors who also invested in these companies who gave them a higher valuation, now they can go brag about how good they are at selecting companies. And they can go raise a bigger fund. That's more fees, and they can just rinse and repeat. All right, okay, I'll stop now. That is enough. If you look at these 4 stories, there are definitely some similarities. Yay for the argument, but that's not the case. The Instagram example, surprise, let's turn that into Instagram. That was acquired by Facebook in 2013 for $1 billion. Now, everyone in that pyramid got paid some real hard cash for that investment. But more importantly, even though the company didn't make any money then, Facebook went out to make billions from that purchase. $32 billion a year as of 2021, just from Instagram ad revenue. That's ROI.
ROI.
Return on
investment. Nope. Radio on internet.
And that's, of course, not a corner case. There are hundreds upon hundreds of startups that have been acquired or gone public and that have become very profitable businesses, objectively valuable companies. So yes, before the company makes a profit, the economics look bad, almost scammy bad, and that's just the truth. There's this massive spend in growth. In order to dominate the world with their product, we would call this owning the market or capturing the market, but there is unprofitability and burn rate every month. But if things work out, and the company does manage to rule the world, then the value is there. It's tangible and it translates into profits per share.
I don't think that the game that I'm playing, at least as a venture capitalist, is a Ponzi scheme at all. So I'm a former founder. I spent 15 years building companies. You know, one of the things that gives me so much joy is actually helping a new generation of great builders to unblock them with capital, knowledge, and networks.
Let's look, for example, at a SaaS company. That's a software as a service. And I'll use the example of Buffer, who's a company I love, and they actually make a lot of their revenue data public. They probably spend hundreds of dollars in content marketing, sponsoring videos on YouTube in order to convert a customer to a plan that may be worth, say, $100 a month. So if they spend, say, $300 to get that customer, it'll take them months to recover what they spent. But if they do, technically they are profiting from that customer. Now, the advantage with subscription platforms is that you can actually predict pretty accurately how much money you're gonna make from a certain group of customers. You just take the average number of customers that cancel in a given month, and you divide that by the total number of customers in the platform. And you'll get this core metric for SaaS called churn rate. Now, if you divide your revenue per customer per month by your churn rate, you will get a golden metric called lifetime value. And if your product is sticky, if your customers are staying for months or maybe years, your lifetime value could be thousands of dollars. So it's a very expensive bet at the beginning to get that customer in. But if you're sure about the numbers, if you're sure about your retention, you will eventually profit from that customer. And that's especially true, of course, with software, because software generally costs very little to operate. It's just, it's very expensive to build and code, but once it's built, it's just servers running somewhere. So companies spend aggressively today, they lose money on a monthly basis, but eventually they can reap those benefits with the customers that they retain or the customers who upgrade. And that's why terms like net revenue retention or net dollar retention are the backbone of SaaS businesses. Now, to explain all of these concepts today, we've made a fair amount of animations on pyramid schemes and Ponzi schemes, but everything that you've just seen on SaaS analytics was just a screen cap of ChartMogul, which is what we actually use to track the metrics of our SaaS business, and they are the sponsor of today's video. We really have been using ChartMogul for years now, as well as Buffer and Teamwork and Hotjar and thousands of other SaaS companies around the world. They are offering a $600 discount for the first 50 people who use the link in the description to sign up to their platform, which, did I mention, is completely free if you have under $10,000 in monthly subscriptions. Thanks again to the ChartMogul team for sponsoring today's video. Now, back to Ponzi schemes. The problem is that the aggressive, the ludicrous spend just doesn't really make sense in the eyes of somebody who doesn't understand what's happening, who doesn't understand the long game that these companies are playing. For example, I also spoke to the CEO of Vivino a few months back. When they launched their platform, all the app did was just let you scan wine bottles. This is long before we had the AI that we have today. You would just scan a wine bottle and you'd get the name of the wine and ratings and reviews for them. And he mentioned that when they launched, they were one of like 20 wine apps that were competing for the light. And I'm sure that every single one of those apps had a team, they had investors who had put money and resources to try and grow that platform, even though they weren't gonna make any money yet. But it was all about the end goal. The app that made it kills it. Most of these competitors died, and for Vivino, winning meant becoming the go-to e-commerce platform for wine, which they're in the process of becoming. It was a very expensive long-term bet. And that is what startups are after. Making fun of Uber is easy. They still haven't turned a profit to this day, but they have transformed transportation. Even today, as Uber trades as a public company in the stock market, investors who put money in the company are playing the long game. If Uber outcompetes and outspends competitors like Lyft, becomes a market leader, optimizes their processes, then yes, they can make a ton of money, a ton of tangible earnings per share. Will they? We don't know. But the value of the company derives from that possibility, as remote as it might be. This is, of course, complete speculation. At the private level, before the company is publicly traded, that speculation is happening between investors, supposedly between experienced investors, investors who are ready to lose their money if their bets don't pay off. When companies become public, there's still a lot of speculation, and things can get fuzzy. You have massive spikes like Tesla a couple years ago, or meme stocks like AMC or GameStop that just trade high because some random bro on Reddit decided so, rather than people actually looking at their profitability or their numbers. And then of course you have stories like Elon on Twitter, or I guess I should say X. Twitter had traded publicly for years, it had not made a single dollar in profit, and well, Elon hasn't figured it out either. Now, we made an entire video about how this speculation has been the driver for so many economic recessions in history. It's a trip down history, and you should check it out. Also, if you'd like to go into more details about the insides of how a VC fund works, we made this cool poker casino theme video explaining how VC works in depth. I'll link to both of those. We'll see you next week.